had discussed a number. When you're talking about tax planning for individual. So number one is what we call occupier interest. We have what we call occupier, call it occupier's interest, so what we call mortgage, the mortgage. Did you discuss this? Was this discussed? If it was discussed, you give me yes. So call it occupier's interest, to what we call mortgage. Did we discuss on that? Yes, and we say that you compare the actual amount with the set limit. So you deduct the lower of the two. So we say this, if you look back what you did, you compare the set limit with what you call the actual amount, the actual mortgage that is paid and the set limit. And if you look back, you notice that we did this. Did we do this? Was this discussed at length? You just give me yes. Perfect. So we can talk about contribution to a registered pension scheme. We can talk about contribution to what I call to a registered, and say pension scheme. So we say contribution to a registered pension scheme. So under contribution to a registered pension scheme, we are basically comparing three things together. We say you are comparing the actual amount of pension, actual amount that is paid by the employee, 30% of the total employment income, and then you compare with the set limit. So again on that, you check the less of the three, the lower of the three. That is what you treat as allowable deduction. Respond to the yes if you're together. We can also talk about what's called, for those that are with disability, when you talk about allowable deduction, expenses that basically relate to their disability. For example, the cost of wheelchair admission, those are allowable deduction. Then you have what's called direct expenses altogether. For example, if you're a salesperson and you basically spend altogether in relation to travel and you're not reimbursed, that will be treated as allowable deduction. We can also talk about, for example, contribution to a registered pension scheme by employee, and if the amount is not reimbursed, then we treat that as allowable deduction. We responded yes. If that is at home, we responded yes. I've added a few. I talked about contribution to a members club. For example, if an employee contributes to for example, to ISPAC, and the amount is basically not reimbursed to the employee, we treat it as allowable deduction. I've also talked about what's called direct expenses. Let's say, for example, you're a salesperson and you're on duty. Maybe you're traveling from county X to county Y, and this amount was in line of your duty. This amount was not basically reimbursed to you. That can be treated as allowable deduction. Together, team, we respond to this. Give me a yes if we are together. Perfect. Then I want to go to what's called set-offs. I want to talk about briefly set-offs. So what we call the tax credit. So what you basically call set-off, so what they call the tax credit. So whenever we talk about set-off, I want you to be very keen and alert. Whenever we talk about set-offs, what is the difference between set-offs and allowable deduction? So number one, allowable deduction will basically deduct them against the taxable benefit before they're subject to taxation. Whenever we talk about set-off, both of them reduce tax, but the set-off, we deduct directly from the gross tax payable. So we say they directly reduce what's called the tax payable to revenue authority. Directly, we say directly, and we say that reduce what we call the tax payable Payable to what? To what you call to the Kenya Revenue Authority. To the Kenya Revenue Authority. Or just say KRA in other. So they directly, so we less them directly from what's called the gross tax pay, from the gross tax payable together. So if you ask what is the difference between allowable deduction and the setup, allowable deduction, we deduct them from taxable benefit before we subject them to taxation. However, for the setup, they reduce directly the tax payable. We less them from the gross tax. So then we have examples. Examples. So number one is personal relief. Personal relief. Personal relief. Personal relief. So who are the ones guys are entitled to personal relief? Who are the ones entitled to personal relief? Remember, this is resident. So this is normally provided in the tax code. Provided in what's called in the tax code, in the tax table. This is normally provided in the tax table. Let us look at the present paper. We say that this is basically provided in the tax table. Look at the tax paper. Look at a present tax table. If you're there, we'll respond with a yes. Look at the present tax table. Up there we have, assume the following tax rates apply throughout the year. Then you have the monthly tax. Then down there we have personal relief. Are you seeing presently 2,400? That is per month. Then we have 28,800. That is per annum. I hope all of us can see that. Are we together? So this one is basically provided in the tax table. So if you check the tax table, you'll basically get it. The second is what you call insurance. Insurance, we call it insurance relief. We call it insurance relief. So the second, we call it insurance relief. Are we together? For those who are contributing to a life cover or education cover, how do you get that? We say this in this. We basically say 15% of premiums paid. Premiums, we say paid. 15% of the premium paid. You compare with what's called the set limit. Set limit, which 5K per month, and what is called 60K per annum. So you pick the lower. When you compare those two, you basically pick what's called the low. You basically pick what's called the lower. To get a team, you pick the lower. We respond with yes. So then we have the next, which you call withholding. Withholding tax at source. Withholding tax at source for amount on incomes. For income, withholding tax at source for incomes, where withholding tax, we say, is not final tax. For incomes where withholding tax is not final tax. So we say withholding tax that is basically back to the source. And this is for incomes where withholding tax is not final tax. Examples of those income, we have the non-qualifying, what's called the non-qualifying, qualifying. We have it as dividends. The non-qualifying dividends, we have non-qualifying interest, non-qualifying interest, non-qualifying interest. But we can also talk about royalty. That is for resident. When we talk about royalty, consultancy and royalty, we can talk about consultancy and royalty. And the word is, this is basically for resident. That is basically for resident. So we can talk about consultancy and royalty income, and that is for resident. Consultancy and what you basically call and royalty, and you say for resident. Together, team. So we say that consultancy, we have the non-qualifying dividends, we have the non-qualifying interest, And then we talk about royalties and consultancy. This is for the resident person. Non-residents, they have a higher withholding tax, but that should be final together too. And that should be final. Give me a yes if you're together. So then we can get the next, we call it double taxation relief, what we call the double taxation. We call it the double taxation relief. And this was basically discussed. Did you discuss the double taxation relief? Were we able to do the double taxation relief? So you compare the tax that is paid at the source country, and the tax that is paid in Kenya. So you less the lower of the two together. Was that exhaustively discussed? Aaron, Florentina, Harriet? Perfect, if that was discussed. Then we talk about pay. These are taxes that are deducted per month. So we have what's called pay. So before we go to capital structure, I want us to pick a number of questions that is on tax planning, and remuneration packages, on tax planning and the remuneration package. The last time that this question was basically tested, I want us to pick the first question. That was August 2025. That was the August 2024, sorry, 2025, sorry, August 2025. We have it as August 2025. That is question 4C. Question 4C. Yeah, that's question 4. August 2025, question 4C. Give me a yes if you're there. If we are there, we respond with yes. If we are there, we respond with yes. Are we on it? If you're on it, we respond with yes. If we're there, we respond with yes. Are we on it? If you're on it, we respond with yes. If we are there, then we respond with yes. So perfect. So we've been told that is possible. Robert Mwema is a senior software engineer. Robert Mwema is a senior software engineer at Steel Limited, and has provided the following details for the year ended December 2024. So the first detail of an income we have what's called a gross salary, which includes what's called the house allowance, which includes the house allowance of 70,000 per annum, So we have a gross salary, a gross monthly salary, which includes what we call a house allowance of 70,000 per annum. So then we have what's called 15% shareholding. He owns 15% shareholding in shares in Innovate Limited. He owns 15% of the shareholding. We say in Innovate Limited, a private consulting company where it receives an annual dividends of 600,000, where it receives an annual dividends of 600,000. So in the third one, we are being told that it resides in a house. It resides in a house. It purchased through a personal loan. It purchased through what's called a personal loan obtained from bank on 1st September 2023 at an interest of 14% per annum, payable over 8 years. So then it contributes 18,000. It contributes what we call 18,000 per month. It contributes what we call 18,000 per month to a SACCO investment, account towards his retirement. So number 3, we are told number 4, sorry, it contributes 18,000 per month to a SACCO investment, accounts towards what we call the retirement. So then we are being told that the next, that is additional information number 5, he has taken a 10-year education insurance policy where he contributes 3,500 per month for his two children, where he contributes what's called 3,000 per month, 3,500 per month for his children's university education. That is the fifth. Then you have the sixth, additional information number 6. You're being told that Robert Mwema has invested 6 million in a fixed deposit account, and a 15-year government infrastructure bond on equal basis. Has invested 6 million, Robert Mwema has invested 6 million in a fixed deposit account and a 15-year government infrastructure bond on equal basis, both earning an interest of 12%. Both earning an interest of 12%. So the last additional information, that is additional information number 7, he also owns a rental apartment, which generates what's called a rental. He owns what's called a rental apartment, which generates what's called a monthly income of 80,000, but incurs what's called an annual expense, of 120 and county land rates of 24,000. So you are required, number 1 required, advise Robert Mwema on 4 tax planning strategy that he could implement to optimize his tax position and legally minimize his annual tax liability from the information provided above. Support your argument with relevant computation where necessary. Support what you call your argument with relevant computation where necessary. So you're being told to advise, this gentleman called Robert Mwema on 4 tax planning strategies that he could implement to optimize his tax position and legally minimize what we call tax liability from the information provided above. Support your argument with computation where necessary. So what are some of the areas that this gentleman can basically minimize his tax liability? Have we discussed something on this one? Do we have notes on those? Have we talked about tax planning for individuals? Have we talked on tax planning for individuals? Tax planning for individuals. Yes, we have. So if you look at the whole story, those additional information, number 1, number 2, number 3, all the way to number 7, what a tax planning opportunity that is basically available for Mwema, this gentleman called Robert Mwema. What are the tax planning opportunity that you say are available for Mwema? What are the tax planning opportunities that you say is available for Mr. Mwema? What are the tax planning opportunities that you say is available for Mwema? What are the tax planning opportunities that are available for Mr. Mwema? So number 1, the first additional information ultimately should be tied to something on the pension. So that one, we can hold it. However, when the examiner tells us, I hope you're very keen. Are we there? If you're there, we respond yes. I want you to be very keen on what I do. I hope you're very keen. So I read the second additional information. So being told that he owns 15% of the share in Innovate Limited, a private consulting company where he receives an annual dividends of 600,000. So what is the tax planning opportunity that is there for him when in relation to what we call owning shares in a private company known as Innovate? How would you advise him as a tax planner? How would you advise him in relation to that additional information number 2? How would you advise him? Would you advise him to increase his shares? Would you advise him to increase his shares? Or you'd basically advise him to reduce his share? How would you advise him? Aaron, how would you advise him? As a tax person, how would you advise him to increase or to reduce his shareholding, to increase or to reduce what he call his shareholding? So number one on that additional information, to increase the shares in Innovate Limited. So I would say to increase, we say its shares in what's called in Innovate Limited. I would advise him as a tax person, I would basically advise him to increase his shares in Innovate. Quinta, why should you, as an advice, why would you advise him to increase his shares in Innovate Limited? Currently, he owns 15%. As a tax person, why would you basically tell him, for example, to increase his shareholding in Innovate? Why would you advise him to increase his shares in Innovate? Why would you advise on such? So the reason why we would basically advise him to increase his shares in Innovate Limited, because if you look at this together, we call it qualifying dividends. When an individuals invest in a company, we call it a qualifying dividends. Dividends. So we basically understand that the withholding tax, on the income, we say is what's called the final tax. Withholding tax of 5% on the income is final tax. So basically saying that if he invests more on Innovate Limited, the withholding tax of 5% should be his only tax. Are we together? As he minimizes tax liability by investing in qualifying dividends, as he minimizes tax liability based on the first information, you give him only yes. As he minimizes tax liability, if you advise him to increase his shareholding, currently stands at 15%, you increase that shareholding probably to, if you can go to 50% altogether, you basically understand that the income that you're going to get from these shares, they're only going to be subjected to 5% withholding tax, and that is fine. That is final. Together, team, and that is fine. And that is fine. Understood. Aaron, is that understood? So that is the first advice in relation to minimizing tax. Florentina, is that at home? Ariet, is that at home? Maina, Quinta, and Tabla. Perfect. So I want to move to the next additional information. So being told that he resides in a house he purchased through a personal loan. A personal loan of 1.5 million obtained from a bank obtained from what we call a bank on 1st September at an interest rate of 14%, repayable in over 8 years. In relation to that point, what do you need to advise? Robert Mwema, in relation to that personal loan? How would you advise Mwema? So he said that this is an area to scoop marks. What should you advise Mwema in relation to that personal loan? To take a mortgage loan. Are we together? Take a mortgage loan. You say take a mortgage loan. Take a mortgage loan. Take what's called a mortgage loan. We call it a mortgage loan. A mortgage loan to do what? To repay what's called the personal. To repay what's called the personal loan. Take what's called a mortgage loan to basically repay what's called the personal loan. But the examiner is very clear. It says something in this particular question. The examiner says that, where possible, also use what's called support with computation. Where possible, support with computation altogether. How much is the loan? So we can say for the loan, look up for the loan, that is 14, an interest of 14% times 1.5. That is 24. What is 14%? An interest of 14% of 1.5. If it takes that loan, what is 14% of 1.5? Let me get my calc. In the meantime, what is the interest of 14%? What is the interest of 14%? What is the interest of 14%? 14%. Interest of 14%. If you check the interest of 14%, so that should be 210. So we have it as 210. So look up. What is the set limit? The set limit for 2024. Why do I go with 2024? So Mwema is a senior software engineer at Steel Limited. It has provided the following detail for the year ended 31st. So that is 2020. For the year ended 31st December 2024. So in 2024, if you look at the mortgage for the year ended December 24, mortgage was basically, if you look at mortgage from January to November, the rate was 25. So 25 times 11. What is 25 times 11? What is 25 times 11? 25 times 11. 25 times 11. 25 times 11. So that should be 275. But remember, in December, the mortgage was basically pushed upward. That was 30. So what is the set limit? So the set limit, that should be 305. So the set limit is basically 305. So which one do we use to reduce the taxable income? Is it the higher or the lower? We use the lower. So basically, is going to use the lower, which is to 10. So the taxable income is going to use the lower to reduce what we call the taxable income. So that number 2, is it okay? Understood. We've done the second. Is that understood? Give money my yes. So then we have additional information number 4. So make sure that he contributes 18,000 per month to a SACCO investment account towards retirement. How would you advise him? Should he continue with a SACCO, or how, in relation to minimizing tax? How would you advise Robert Mwem? Should he continue to contribute to? Should he continue to basically contribute to a SACCO, or what should you advise him as a tax expert? Where should he invest, Aaron? Where should this contribute to? It should basically, instead of a SACCO, it should contribute. We know that it should contribute. We would advise him to contribute. The word is contribute to what we call to a registered. We call it registered. We call it pension scheme. It should basically contribute to what's called to a registered pension scheme. So on a registered pension scheme, if you look at a registered pension scheme, we're saying that what is the actual contribution? The actual contribution would be 18,000 times 12. What do you get? 18,000 times 12. I don't know. So that should be 2 to 16. To 16. What is the set limit? What is the set limit? We have 20 times 11. 30 was basically, remember that is 2020, 2024. So that is not 2025. So 2024, for the first 11 months, it was 20. So 20 times 11, then you add 30. What should be the set limit? 20 times 11, 20 times 11, then you add the 30. So the set limit was basically 270. Is it 250 or 270? 11 times 20, that is 220, plus 30, that should be 250. So, and you also have what's called 30%. What we call 30% of what? Of the employment income. 30% of the employment income. I want us to look at the additional information number one. Look at this additional information number one. He has what you call, he has the monthly salary. We are told he has a monthly salary of 250, a monthly salary of 250, which also include a house allowance of 80,000, of what they call 70,000 per annum. He has a monthly salary of 250, which includes a house allowance of 70,000. So how much is the salary per month? How much is the salary per month? How much is the salary per month? So the issue that he has a monthly salary of 250, which includes 70,000, which includes what's called 70,000. That should have been per month. Are we together? There's something wrong with that. So when you less that, we have 180. 180 times 12, 180 times 12, 180 times 12. What do you get with the 180 times 12? 180 times 12. 180 times 12. So that should be 20. Plus that 70, we have 70. That will say per annum. If it's per annum, then plus 70. If that's per annum, plus 70. What is the total plus 70? 2.1 plus 70. 2.1 plus 70 plus 70. That should be 22. So if you get the 30% of the total employment income, which is 21, it still should be more. That should still be more. How much would that be? 30% of the employment income. So if you get the 30%, if you get 30% of 20, you say 2230. 2230. 30% of 2230. What should that be? So what is the 30% of 2230? Masharia? So that should be 669, around 669. This 669K. So we take the law. What amount is it going to reduce the tax with if it contributes? That's 216. Are we together? 216? 216. Are we together? That should be 216. 216. If you look at questions, this is always the higher. But again, it's always good to remember, you also compare with 30% of the gross employment income. So if you contribute to a registered pension, it's going to deduct 216 against what you call a taxable income. Therefore, reducing what you call the income that is subjected to taxation, and therefore it reduces what you call the tax. Give me a yes if you're together. Give me a yes if you're together. So then we move to the next. It moves to the next. So the next additional information, we're being told that he has taken a 10-year education insurance policy where he contributes 3,500, where he contributes what's called the 3,500 per month for his 2 children's university education. Is there any tax planning on that? What do you say contribution to an education cover? Contribution to an education cover. Is there a tax planning opportunity in that? Quinta, is there a tax planning opportunity? Yes. If you're contributing to education cover, contributing, we have it contributing to what we call to a insurance cover. To an insurance cover, and to be precise, that is education cover. So what is the total premium? Total premium for the year 2014. Total premiums, 3,500 times 12. 3,500 times 12. 3,500 times 12. So that should give us the total premium. 3,500 times 12 to give us the total premium. 3,500, that is 42. So say 15%, 15% times 42 times 42, you compare with the set limit. We have a set limit of 60K. So what is 15% of the premium for that particular year? 15% of 42. 15% of 42. 15% of 42. So that should be, we have it as 63. 63. So which one do you take? We have 63. But this one we less directly. We know that we're going to less directly from what we call from the gross tax, from the gross tax payable. We less it directly from the gross tax payable. Is that okay? We less it directly from the gross tax payable. Give me a yes if you're together. Perfect. So then we get to the additional information number 6. We get to the additional information number 6. So being told that in additional information number 6, Robert Mwema has invested 6 million in a fixed deposit, account, in a fixed deposit account, in the 15-year government infrastructure bond on equal basis, both earning an annual interest of 15%. So he has 6 million. He has 6 million. One is on infrastructure. One is basically on infrastructure bond. So out of the 6 million, he has invested on infrastructure bond, but you're also being told that he also invested in a fixed deposit account. He has also invested in a fixed deposit. We call it deposit account. He has also invested in a fixed deposit account. Is there a tax planning opportunity? Meaning that implies that he has invested 3 million. Both of them are earning interest of 12% per annum. Interest of 12% per annum. Both of them are basically earning interest of 12% per annum. Again, 12% per annum. Both of them are basically earning interest of 12% per annum. So is there a tax planning opportunity? You need to understand this. If an individual contributes to a fixed deposit account, yes, that is good. If an individual basically contributes to a fixed deposit account, how do we call it in relation to interest? Is it qualifying, non-qualifying, or interest exempted from tax? When an individual contributes to a fixed deposit account, that is a qualifying. We call it a qualifying interest. So when you talk about qualifying interest, basically understand that the withholding tax of 15% is final tax. So on the interest that basically is receiving, the taxman is getting 15% withholding tax. What about contribution to on infrastructure bond? When you talk about exempted from tax. So how should you advise this gentleman? This is now 5 in relation. Should we continue with this or put the money on infrastructure bond? Should we continue with a fixed deposit or put the money on infrastructure bonds? issued, channel the money, channel the money, we say on what's called on infrastructure, on the infrastructure bond. So interest from infrastructure bond is exempted from tax. Interest, we understand that from what we call infrastructure bond, we say is exempted from tax. From infrastructure bond is exempted from tax. So you basically understand that interest from infrastructure bond is basically exempted from tax. Understood? Florentina, is that understood? I hope that is understood. Is that understood? Perfect. So then we can read the additional information number 7. So I've been told that he also owns what we call rental apartment, which generates what we call a monthly rental income of 80,000, but incurs what we call an annual maintenance, but incurs what we call an annual maintenance expense of 120 and a county land rates of 24. Apartments. Is there any saving on that? Do you think we have a tax saving on that? Do you think we have a tax saving on that? So there's not a tax saving on that. So with that, each is 2 marks. If you 1, 2, 3, we have 4, we have 5 for any. Is that not a very good area to score marks? Is that not a good area to score marks? If that is a good area to score marks, then we can respond with a yes. Yes, it is a very good area. If you're very keen on it, you can. So we could go to the next question. That is May 2019, question 3B. We have May 2019. May 2019. We have it as question 3B. May 2019, question 3B. That is the next example. May 2019, question 3B. Give me a yes if you do that. On May 2019, question 3B. If you are there, you give more yes. Open May 2019, question 3B. If you're there, you give more yes. If we are there, we respond with yes. May 2019, question 3B. So thank you so much. So then we proceed. We're being told that Peter Samoei is an employee of Zawadi Limited and earns a salary of 140, enhanced salary of 140,000 per month. Enhance a salary of 140,000 per month. While his wife, Sabina Wanga, works in Lindy Limited, a firm that Samoei controls, while his wife, called Sabina Wanga, works in Lindy Limited, a firm which Samoei controls 18% of the share capital. A firm that Samoei controls 18% of the share capital. Our salary is shilling 60,000 per month. Our salary is shilling 60,000 per month. Sabina Wanga owns a house which is occupied by the family, for which the rental value is 45,000 per month. The house was constructed in the year 2017 at a cost of 6 million, borrowed from a SACCO, and you say at an interest rate of 12%. Sabina has insured the house and pays insurance premium and pays what's called insurance premium of 4,800 per month and the city council rate of 6,900 per annum. So being told that Mr. Samoy pays insurance premium for his family of shillings 4,600 of shillings 4,600 with an insurance company incorporated in Uganda, but operating in Kenya. Then it says the Wadi Limited paid school fee of 80,000 for the couple's children, which was expensed in the farm's income statement, So last we're being told that Zawadi Limited paid school fee of shillings 80,000 for the couple's children, which was expensed in the farm's income statement. So then we go to the required. So being told that to suggest what we call 4 tax planning schemes that could minimize what we call the tax liability of the family. So based on the information that we are given, what are the tax strategies that could minimize what we call the tax liability for the family? We'll start with the first one. So the first statement, you're being told that Peter Samoei is an employee of Zawadi Limited and earns a salary of 140. His wife, Sabina Wanga, works in Lindi Limited, a firm in which Samoei controls 18% of the share capital. So from there, do you think there's a tax minimizing opportunity that is there? A firm that Samoei basically controls 18% on that Lindi Limited. So what should he do if he controls 12.5% of the shares? What should he do? So you can have that as a first. What should he do? And what is the implication of it? He should reduce the shares to less than 12.5%. So number one, we know that Mr. Samoei, we say should reduce what we call the shares. It should reduce what we call the shares to what we call to less than what we call 12.5%. It should basically reduce the shares to less than 12.5%. What is the implication of that? So this is the Lindi Limited. That is in Lindi Limited. What is the implication of that? The implication of that, so that they're basically taxed separately. So that we say they are, and the word is taxed separately. So that they're basically taxed separately. What is the implication of them being taxed separately? What is the implication? They're entitled to personal relief. So if they're taxed separately, are we together? Ensure that each of them, this ensures that each of them, based on the present tax rate, each of them enjoys what's called a personal relief, let me say, of 28,800. Each of them to enjoy a personal relief of 28,800 per annum. That implies that if you're taxed separately, if you reduce the shares to less than 12.5%, they're definitely going to be taxed separately. And when they're taxed separately, each is going to enjoy what we call a personal relief of 28,800. So if the whole income was going to be taxed on Mr. Samoei, what would happen? If the income that is basically earned by the wife, Sabina Wanga, what would be the implication of it? So it was going to be entitled to one personal relief, and the income would be, he would enjoy one person will leave, and the income would be taxed at a higher tax rate, So it's definitely it was going to enjoy one single personal relief, and the income was going to be taxed on a higher tax rate. Is that understood? We respond with a yes if that is at all. If there's a question, we can ask if that is at all. We give it a yes. So that is the past. So this was also looking for 4. So we can get to the next. We can get to the next. So being told the next, we're being told that the house, we're being told that our salary is 60,000 per month. They're being told Sabina Wanga owns a house which is occupied by the family, for which the market rental value is 5,000 per month. The house was constructed in the year 2017 at a cost of 6 million, borrowed from a SACCO at an interest of 12%. Is there a tax planning opportunity on that? Are we together? That loan that was borrowed from a SACCO. So what should happen to that loan that was basically borrowed from SACCO? What should happen to that loan that we say was borrowed from a SACCO? So what should that loan be done to? A loan that was basically borrowed from a SACCO. Yes, it should take a mortgage to offset. Take a mortgage to offset the loan. Take what you call a mortgage. A mortgage to do what? To offset what you call the loan. Take a mortgage basically to offset what you call a loan. Take a mortgage to offset a loan. Take what you call a mortgage to offset a loan. What is how do you treat a mortgage interest? That's allowable deduction. We can also, what is the loan? The loan is 6 million. If the loan is 6 million, what is the interest on loan? We say mortgage interest. You need to understand that mortgage interest is what they call is allowable. We say allowable deduction. So mortgage interest is basically an allowable deduction. So what is the interest on the loan? If that loan is taken, what is the interest on the loan? Interest on the loan. So what is the interest rate based on that question? So the question, the mortgage, that was, if you look at 12%. So if you look at 12%, 12% times what? Times 6 million. Times 12 million. So what is 12% of that? So we have what's called 720. So what is the set limit? Because we've used this for 2020, for 2025. We make this. What is the set limit for 2024? If you pick this as 2024, what would be the set limit? What would be the set limit? 2024. 2025, the whole of it will be 360. 2024, remember from December, that should be 305. Remember what you said, 305? That should be 305 because the first 11 months, it was 25, then it was pushed to 30. If you pick it as 2024, are we together? So you pick the lower. Is that noted? We are saying, you see the first 11 months, Samikis. Are we there, Samikis? Give me a yes, Samikis, if you're there. The first 11 months, the mortgage was just 25. However, from December, the mortgage was basically pushed to 30. That's why we say 305. Is that noted? Are we together? Perfect. So is able to reduce it by, so you pick the law. So we basically understand is able to reduce it by 305. Are we together? Is able to reduce the taxable income because that's an allowable deduction, is able to reduce the taxable income by 3 or 5. Is that understood? The second one? Give me yes if the second one is understood. So we proceed to the next. Then we have 3. We have the 3 here. We have the 3. So being shown on the 3, Sabina has insured a house. Sabina has insured a house and pays an insurance premium. Pays an insurance premium of 4,800 per month, and the city county rate, and the city county rate, a city county rate of 6,900. 6,900. Is there any tax planning opportunity there? Is there any tax planning opportunity? Insurance relief. What would be the insurance relief? What would be the insurance relief on that? What would be the insurance relief? What would be the insurance relief? So is that an education cover or a life cover? That cover, is it entitled to for that? Is the cover entitled to a relief? The cover that he has? Is the cover entitled to a relief? Is that cover entitled to a relief? So for that cover, no. For that cover, no. No. So then we move to the next altogether. We move to the next. We move to the next. So we're being told that the next that Mr. Samoy pays what's called paid insurance premium for family. That's now a cover, a life cover of 4,600 with an insurance company incorporated in Uganda, but operating in Kenya. So Mr. Samoy pays what's called an insurance premium for what you call for a family of shillings 4,600. We say he paid 4,600 with insurance company incorporated in Uganda, but operating in Kenya. What should you do? What should you do? He should transfer the insurance cover to Kenya. So basically, he needs to do what? To transfer. The word is to transfer family insurance cover from a company incorporated in Uganda to Kenya. Transfer, what do you call? Transfer. We say transfer. Transfer. We say transfer. The insurance cover. Insurance cover. We say from a company. From a company. We say incorporated. Incorporated in Uganda to a company. We'll say to a company incorporated in Kenya. In Kenya. And the word is so as to do what? To enjoy. We say to enjoy what's called insurance relief. Insurance relief. So as to enjoy what's called insurance relief. Is that understood? Give me yes. So as to enjoy what's called an insurance relief. So if that was the contribution per month, if you're looking for relief per month, relief that is incorporated, relief per month. So say 15% times the figure is 46. You compare with the set limit of 5,000 per month. So how much relief does he enjoy per month? 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 Florentina? So that should be 690. So if you look at it monthly, it should be reducing directly from the tax payable, that is 680. Is that understood? If that is understood, you give Mwalimu a yes. If that is understood, we responded yes. So then we pick is this space enough? So we can move to this space so that we read the next statement. So the last statement, we are being told that Zawadi Limited, Zawadi Limited, Zawadi Limited, we say Zawadi Limited paid school fee of shillings 80,000 for the couple's children, which was expensed in the firm's income statement. What should they do? Which was basically expensed. If it was expensed in the company's income statement, what does it mean? If that school fee for the employees' children was expensed in the income statement, what is the implication of that? And what should be done if there's an issue with that? What should be done if there's an issue with that? What should be done if there's an issue with that? If the school fee is expensed in the income statement, what does it mean? Should we tax it on some way? If it's expensed in the income statement, what did you say? If the school fee is expensed in the income statement, is it going to be taxed on the employee if the school fee is expensed in the income statement? Do we tax it on the employee? Yes. So what should be done? What should be done in order for them not to be subjected to minimize? What should be done? So if the school fee is basically expensed in the income statement, yes, it should not be expensed. So say Mr. Samoy should request Zawadi Limited. Mr. Samoy should request, should request Zawadi Limited. Mr. Samoy should basically request Zawadi Limited. Employer not to expense. So what do you call employer? Employer not to do what? Not to expense. Not to expense. What do you call the school fee? The school fee in what you call in the income statement. In the income statement. If it's not expense, then therefore it becomes what you call a tax exempt on employee. Tax exempt on employee. It becomes what you call a tax exempt on employee. Is that understood? It becomes a tax exempt on the employee. Is that understood? Perfect. So we can take our break, 10 minutes break, then we come back. Unless somebody has a question, we can have our 10 minutes break, then we come back. Together, team. Perfect. We can take our break. Are we there? Perfect. So I want to briefly take these minutes that we have to talk about capital structure. There's a concept that I think was tested. The last time it was tested was 2015, but I think there was an aspect of capital structure that was basically tested. I think the last sitting, are we together? So whenever we talk about capital structure, at the back of the mind, you need to understand that capital structure refers to what we call composition or what we call the long-term financing. So say that capital structure basically refers to what we call composition. It refers to what we call, refers to the composition. We call it composition of what we call of a long-term financing. We call it composition of what we call a long-term financing together. So whenever we talk about capital structure, it basically refers to what we call composition of what we basically call long-term financing, and you say of a company. long-term financing of a company. Together, team, Zipporah, Samikis, Florentina, Maina, and Aaron. Perfect. That is composition of what we call the long-term financing of a company. When it comes to long-term financing of a company, you basically have two. There are two types altogether. There are two types of long-term finance, two types of what they call, two types of what they call long-term financing. So when you talk about two types of long-term financing, we basically have what's called two types of long-term finance. So we have 1 and 2. So if you look at the two items that I'm talking about, we type them along the way. So we have what's called owner's capital and what we call interest-bearing debt. Owner's capital, and then you have what's called interest and interest-bearing debt. So the two types of long-term financing, we have what's basically called the owner's capital and what's called the interest-bearing debt. So which one is the best form of financing? That we know, we say that which one should we go and why? Should you use owner's capital or the interest-bearing debt? Which one is the best interest-bearing debt? Why? For the interest-bearing debt. Why the interest-bearing debt? Because interest that accrue from those loans are treated as allowable deduction. So we start with the first one, which is basically owners. We call it owners capital. And we get the composition of what we call owners capital. So whenever we talk about owners capital, yes, it's allowable. Interest that accrue is allowable. So the composition of what we call the owners what we call owners capital. It consists of what's called ordinary share capital, preference share capital. We have reserves and retained earnings and losses altogether. So it consists of, this will basically consist of what we call ordinary share capital, and then you have what's called preference share capital, preference share capital. We have the ordinary share capital. We have the preference share capital. We have reserves. We have the reserves. We have what's called retained. We have it called retained. We have it as retained profit, retained earnings and losses, retained earnings and what's called losses. So this is the composition of what's called owners capital. Give me a yes if you're together. If we are together. So interest bearing, what do you call the interest bearing debt? The second one, we call it the interest bearing debt. So examples of an interest bearing debt, we have what's called bank loan, debentures, and bonds altogether. Bank loans, we have the debentures, and what's called the bonds. And the bonds. Those are examples of what you basically call just a minute, I get my list. Example of a long-term interest-bearing debt. So we've all agreed that if you're to basically choose a means of financing, we'll definitely go for what you call an interest-bearing debt. Why? Because interest that accrue from it, is basically an allowable deduction. So say, from tax point, it is cheaper basically to finance activity from tax point. We say from what we call from tax point, we say it is cheaper, the word is cheaper to finance through debt, rather than owner's capital. That is, from the tax point, it's cheaper to finance through debt rather than owner's capital, rather than what's called the owner's capital. This is because we say that interest that accrue from debt will stand at interest that we say that accrues from what we call from a debt. From debt, we say is treated, we say as allowable deduction. Is treated as allowable deduction. That is because that interest that basically accrue from a debt is basically treated as allowable deduction. So from the tax point, we have all agreed that it's far much cheaper to finance through debt because interest that accrue from a loan is basically treated as allowable deduction. So the cost of what's called the cost of capital, owner's capital, we have what's called dividends. Owner's capital, we have owner's capital. Capital, we have the dividends, and we treat dividends as none. This is non-allowable expense. This is non-allowable expense. This is non-allowable expense. So we have a tax saving. So when you use debt to finance, when you use what you call a debt to finance a loan, we have what's called a tax saving altogether. We have what's called a tax saving altogether. So we need to ask ourselves that how do you get the tax saving? A tax saving. Tax saving. So we say that the amount of tax saving, amount of tax saving, amount of what's called of tax saving, amount of tax saving. I know this is a concept that you've also touched in FM, but probably a little bit different. Amount of tax saving, call it amount of tax saving, which a company makes, makes from what we call from financing through debt, that is say rather than ordinary share capital is called, we call it in tax, is called, and I know the same concept you touch in FM, is basically called what's called interest tax shield. It's basically called the interest tax shield. Have you ever heard of this concept in FM? It's called what's called the interest tax shield. Interest tax shield. So how do you get the interest tax shield? That is our concern. Interest tax shield. Interest tax shield. Interest tax shield. If you're able to save on mortgage, let's say, for example, you're able to save 100,000. 100,000. Let's say, for example, from a loan interest, you're able to save 100,000. How much tax are you saving? You see, you less the taxable income by 100. Interest on loan is 100,000. Interest on loan. How much tax are you saving? Logically, how much tax are you saving? If you have interest on loan, you get the interest principal amount times the interest, you get the interest. So if you're able to save 100, you're able to save 70% altogether. You're able to save, no, the tax, no, that is on the tax. How much tax are you saving? Because the tax is going to go for 30%, 30% altogether. So we get the interest tax shield by saying 30% of that, we'll say 30% times, we have the principal amount of loan principal amount of loan times what we call times the interest rate. We don't say 70 interest rate. This is the transfer times the interest rate of what we call of the debt. Logically, do you understand that's important? So let's say, for example, we have an interest. If you calculate this, you have an interest of 100,000 and you deduct that 100,000. So you're able to save 30% in relation to tax. So that is what we call the interest tax shield. Together. Aaron, Samikis, Florentina, Marina, Tebla, and Zipporah. If you're together, we respond with this. Perfect. So then I want to talk about thin capitalization. They have of late not basically looked at this a lot. Thin capitalization. So we talk about what's called thin capitalization. What we call the thin capitalization. Thin capitalization. Allow me to explain. So on the thin capitalization, whenever we talk about thin capitalization, this basically affects companies which are foreign controlled. So whenever we talk about thin capitalization, it basically affects companies that are basically foreign controlled. Are we together? Foreign controlled. That is the back of the mind. Aaron, I'll say that this basically, when you talk about the concept of thin capitalization, it basically affects companies. We call it companies. We call it companies that we say that are what's called foreign controlled. So when I say foreign controlled, what does it mean? When I say foreign controlled, it basically affects companies that are basically foreign controlled. What do I mean? So it basically means that 20% or more of the shares is basically controlled by foreigners. Together on board, 20% or more of the shares, we're saying that 20% or more of the shares are basically controlled by the foreigners. So say 20% or more of the shares, we say 20% or what's called more of the shares, we say are controlled by what's called by foreigners. 20% or more of the shares are basically controlled by the foreigners. Where we basically, where we say that where capital, where we say owner's capital debt ratio, and you say where owner's capital to debt ratio should be 1 to 3. So we say that if you have owner's capital, so owner's capital to debt ratio, owner's capital for this, owner's capital to debt ratio, to debt should be 1 to 3. Together too. So now I want to owner's capital to debt ratio should be in a ratio. So it basically means that if owner's capital is let's say $1 million, what should be the debt? What should that be ratio? If we have owner's capital to be $1 million, what should be the debt in the column? What should be the debt? If the owner's capital is $1 million, what should be the debt? That should be $3 million. So we are saying that when this happens, is not supposed to exceed. So should be. So should not exceed. Should not exceed. We say should not exceed the ratio. We call it the ratio mentioned. Should not exceed. So when a company is basically foreign control, the ratio of owner's capital to debt ratio should not basically exceed 1 to 3. So when it exceeds this ratio, we call it, that is what we call thin capitalization. So if you're trying to identify whether a company is thinly capitalized altogether, then you look at the debt ratio. There's ownership, there's foreigners in the ownership, and we say that if the capital when this ratio is exceeded, let's say, for example, owner's capital to this is 3.6. It exceeds that ratio. Or say it is 1 to 5, then these ones are basically thinly capital, are thinly capitalized. Together too. If that ratio is exceeded, we say that those companies are thinly capitalized together. Perfect. So I need to put it in words there. So when this ratio is exceeded, we need when the ratio we say is exceeded, we say when the ratio is basically exceeded, we say that when the ratio is exceeded, when the ratio is exceeded, it is considered to be thinly capitalized. It is considered to be basically thinly capitalized. However, this question, it has taken a bit of time. What informed me is, if you look at the last sitting, particularly question on mining, there was something on thinly capitalized altogether. This means a huge amount. What does it mean? What does it mean? Now, if the ratio exists this, and let's say it's 1 to 5. So a huge amount of what is financed through what? We say that if it exceeds this ratio that we have, then we therefore call that company is basically thinly capitalized. And what are we saying? A ratio is 1 to 5. What does it basically imply? A huge amount of what is financed through the debt together. We just can understand better. A huge amount of long-term finance. So this is a huge amount, a huge. That basically implies a huge amount of long-term finance. Long-term finance is basically through what's called through debt. A huge amount of long-term finance, it basically implies that it's through debt. It basically implies that a huge amount of long-term financing basically comes through the debt altogether. So the consequences of thin capitalization. So we talk about consequence of what we call thin capitalization. So the consequence of the thin capitalization, we basically understand that the consequence of what we call a thin capitalization, the consequence of a thin capitalization is that only amount of debt, we call it only amount of what we call debt. Only amount of debt, we call it only amount of debt, whose interest is allowable. Only amount of interest, only amount of debt whose interest is allowable. Whose interest is allowable. Only amount of debt whose interest is allowable. Whose interest is treated as allowable. Whose interest is treated as allowable. Whose interest basically is treated as allowable is the one which we say is the one which is 30%. We say is 30% of what I call, look at three things, which is treated as allowable, is the one which 30% of profit before profit. We call it profit before tax, profit before tax, profit before interest, profit before interest is the one 30% of profit before interest, depreciation, and amortization. Before, so we say 30% of profit, we say profit before 30% of interest, 30% of what we call before interest, before interest tax. We have depreciation, and what's called amortization together. The only amount of debt whose interest is treated as allowable is one which is 30% before interest, tax, depreciation, and amortization. Give me a yes if you're together. If you're together up to that point, you give me a yes. Perfect. So when a company, you can ask a simple question, 2 marks. Is the company thinly capitalized? You check on what's called the ratio. To confirm whether the company, already if they're talking about thin capitalization, it basically means that the companies, there's a foreign element in the company. But how do we test whether it's thinly capitalized? We get the ratio of owner's capital to debt altogether. Already when they told you to find thin capitalization, it basically implies that there's a foreign element in the company. Are we together, team? It basically implies that there's a foreign element in a company. So how do we test? We just get the ratio between owner's capital and the long-term debt. Is that okay? Perfect. Yes. So if that ratio is exceeded, then that informs us that company is basically thinly capitalized. I talked about 2 things, composition of owners. I talked about composition of owners capital. We say that the composition is ordinary share capital. We have preference, we have the reserves, we have retained earnings and losses. If there's a loss, we basically less from the ordinary. We have ordinary shares, preference, reserves. If there's a profit, we add. If the loss, we less to get what you call the owner's capital. Together, team. You see, one of the areas that might, maybe will give a student's problem is how to get owner's capital. But you say owner's capital, the composition is, we have ordinary shares, we have the preference, we have the reserves, we have retained earnings, to what we call losses. If there's a loss, then we less. We add the ordinary, we have the preference, we have the reserves, then we less the losses. If it's a profit, we had. But this is how we basically get a thinly capitalized company. No, it cannot. You see, it must, in most of the questions, it basically, when it's less, it does not meet more. It will basically just to meet this threshold. In questions, you not have it as less than together. That is the minimum threshold that you should have. Are we together? You not have 1 to 2. Is that okay, some kids? You not have 1 to 2. Are we together? So then the last concept on this is basically institutions that are excluded from thin capitalization provision. So we have what's called institutions that are basically that are excluded from thin capitalization. So some of the institutions that are basically excluded from what we call the thin capitalization, we have the bank and non-bank financial institution. Are we together? So companies or institutions that are basically excluded from thin capitalization, we have the banks and what we call an other financial institution that basically excluded from thin capitalization. Together, team, and the rest you can basically get from the notes. Give me a yes if you're together. Give me a yes if you're together. Perfect. And I say that this concept was basically tested the last time that it was tested highly, that is around 2015. Around 2015. If you look at 2015, 2013, you find that these questions were tested altogether. However, there's something that was asked. I think that was the last exam on thin capitalization. There was a concept that was basically asked on thin capitalization. That's why we are going to look at. But I'm going to check on questions that are basically there in 2015 or 2013, so that we can pick maybe an example or 2, so that we look at the concepts that we have basically done. Together, team, we respond to this, if that is okay. If that is okay, we respond to this. So allow me to stop at that point. Allow me to stop at that point today. Looking forward for Sunday. So we meet on a Sunday. Yes. And we'll plan ourselves properly on Sunday. Yes, because we are to the end. we plan ourselves properly on Sunday, and we know what you're doing in theory that is remaining, because what is pending, the other things that are remaining, tax system, I think is a concept that was done on PFT, the types of tax systems, tax policies. We are going to talk about tax system. Uh, uh, so basically, those are theory, but we'll plan ourselves on what to do about it. So we close it there. God bless you, and God bless our cause. Unless there's something that is burning that cannot be postponed. Thank you, Zipporah. So we have what's called factors that we say influences demand. Factors that we say influences demand. So we are on which number on factors that influences demand? Which particular number are we in? On what we call on factors that influences demand. On factors that we say influences demand. Factors that influences demand. So we were basically, you say we were basically on 2. So we did the income. That was the income. Income was a 2. So that was income. Just note here. So many to the get. So we on the second part, we called it income. We called it income. We called it income. So for the income, we did say that for the income, for the normal goods, the higher the income, the higher the quantity demanded. But you had what we call exceptions. On this, we had exception. We had what we call exceptions. So exceptions was basically on the inferior. We had it on inferior goods and what we call in the necessity. We call it the necessity. So the exception was basically on the inferior good. Then we had it on necessity. Exception was basically on the inferior good and what we basically called necessity. So exception was basically on the inferior good and what we had on necessity. So if you have, for example, we have quantity here, and then we have what's called income. We have quantity on the side, and then we have income. For a normal good, this is a normal good. If you have this, this is for a normal good. Respond with a yes, you can see that. That is basically for a normal good. So when you have this is basically for an inferior. Inferior. Call it inferior good. So this is for an inferior good. Then we have what we call necessity. So for a necessity, we had this for necessity. We call it necessity. Together, team, call it necessity. We call it necessity, necessity. Together, we respond to the yes. That's number 2. Is that understood? We'll respond to the yes. So then we have future expectation of price changes. So number 3 is what's called future expectation of what we call of the price changes. So future expectation of the price changes. So on what we call the future expectation of price changes, we need to understand that if a consumer expects the price of commodity to rise in the future, expect what's called the price of what we call of commodity, we say to rise in the future, to do what? To rise in the future, to rise in the future. If they expect the price of commodity, they expect the price of commodity to rise in the future, what will happen to the demand now? What will happen to the demand now? The demand will be high. If the future demand will be high now, and we say and vice versa. The demand will definitely be high now and vice versa. So if we expect the price of a commodity to rise in the future, nobody wants to buy when the price is high. So presently the demand is going to be very high and vice versa. Is that okay? Respond with a yes if you're together on that. Respond with a yes if you're there. Perfect. So then we have the next factor, we call it population. Call it population. So understand that the higher the population, the higher the demand. The higher the population, the higher the demand, and vice versa. The higher the population, we say that the higher the demand, and what's called and vice versa. So why do you think people would want to sell where there are so many people? Because the higher the population, we have what's called the higher demand. Especially if it's for basic need, you realize the demand will be very high where the population is high together. So then you say price of other goods, other related goods, say price of what you call of other, and you call it related goods. Price of what you call other related goods. So when you talk about related goods, we're talking about substitute, One is what called substitute goods. And then you have what's called complementary. Goods. So we have what's called substitute goods, and then we have what's called complementary goods. We have what's called substitute goods, and then we have what's called complementary goods. So we have what's called supplementary goods. We have what we call complementary goods. So substitute goods, we can use them for in place of the other. Complementary, they must work in. We must use them together. Are we together? So when you talk about, if you talk about the substitute, the demand of good goes up. Demand of a good goes up, goes up if the price of what they call of substitute increases. So basically, understand that the demand of a good goes up if the price of substitute increases. So examples of what we call substitute coffee and tea. If the price of coffee is high, people will go for tea. Are we together? E.g., we say quantity demand of tea increase if, i.e., we say quantity demanded of tea, we say increases if the price of what we call of coffee increases. So quantity demanded of tea increases if the price of coffee increases. Are we together? That's how substitute operate. Then we have what we call complementary. We have what we call the complementary. So complementary goods must work together. So whenever you're talking about complementary goods, they must work together. So if the price of goods, one increases, you know that the demand for the other will not be there. So you know that demand for goods goes up if the price of complementary decreases. Demand of one good goes up if the price of what we call complementary, we say decreases. If the price of complementary decreases. So if Complementary, for example, car and fuel. If fuel is cheap, demand of cars will be high. I will take it down. More fuel is demanded when the price of vehicles go down. E.g., more fuel demanded. E.g., we say more fuel demanded. If what we call if the price, we call it if the price of cars goes down, or cars goes down. So if the price of cars goes down, automatically fuel will be demanded. Understood, Brian and Jane? If that is understood, we'll respond with a yes. We respond to this. Then we go to fashion. Fashion. How does fashion affect demand? This is especially to young people. Fashion accelerates what's called demand. Fashion would basically, demand is high for goods that are in fashion. Demand high for goods in fashion. Demand, we say, is high. But say for goods in what's called in fashion, and low for what we call for goods, and we understand that out of what we call out of fashion. So the demand is definitely high for goods that are basically in fashion, and the demand is low for goods that are out of fashion. Demand is low for goods that we basically understand are out of fashion. Are we together? So we need to understand that demand for fashionable goods goes against the law of demand. Demand for fashionable goods, because people can buy even in price, even in higher price, and B, demand for what they call for fashionable goods goes, the word is goes against the law of demand. So demand for fashionable goods basically goes against the law of demand. Then we can talk about what's called seasons. Are we together? Seasons. We can talk about what's called season. When is the right time to sell umbrellas? When is the right time to sell umbrellas? Brian, for you. When is the right time to sell umbrella and sweaters? You are now an economist. When is the right time to sell umbrellas and sweaters? When it's raining. So it's when you want to get people, a lot of people, is when it's raining. When is the right time to sell light clothes? When is the right time to sell light clothes? Light, very light. When it's very hot together. So it changes the season, the demand for clothes. Warm clothes is high during cold season, i.e., demand for warm clothes, i.e., demand for what they call for warm clothes, high, and call it during cold season. So demand for warm clothes is basically high, and call it during the cold season. So if you look at the cold season, you realize that demand for warm clothes is basically high. Then when you look at it's very high for warm clothes, and low during hot season, and low during hot season, and low during hot season. So then we go to the next factor, we call it taste and what's called preferences. Taste and what's called preferences. What we call taste and preferences. We call it taste and what we call preference. We call it taste and preference. Demand is high for goods that are of people's taste. When people have a product, the demand becomes very high. So demand is high for goods that are people taste and preference. Demand is high for goods that are of what you call of people's taste and what you call preference, and vice versa. So when people love something, the demand automatically shoots. Karibu Debbie. Automatically it shoots. Automatically it shoots. Automatically it shoots. For those goods that people definitely love, the demand will basically shoot, and vice versa for those that people do not love. So then I can discuss what the last one, we call it advertising, the level of advertising, level of what you call of advertising. So what you call the level of advertising. So why do you advertise when you have a business or when you have a product you advertise? So advertising, number one, at the back of your mind creates what you call awareness. Are we together? So extensive advertising leads to high demand and vice versa. Extensive, call it advertising. Advertising, we understand that leads to high demand and what you call and vice versa. Extensive advertising definitely leads to high demand and vice versa. If you do not advertise rigorously, then we understand that the demand will definitely go down. If you do not advertise extensively, then we understand that demand is likely to go down. We understand that the demand is likely to go down. Then we can talk about availability of credit. When you talk about availability, I'll give you assignment, availability of what we call credit. If, for example, we give each one a credit facility of $1 million, what will happen, David? If you give a credit facility to people of $1 million each person, when people have money, their demand shoots. So when you talk about availability, influences demand for a commodity. With credit facility, higher credit facility leads to what we call higher demand. Higher demand. Have you ever seen apps on loans? These apps on loans that give credit, they create higher demand, even for things that people do not love. Now for you, assignment, how does this one affect demand? Government policy. Government policy. We have custom and tradition. Custom and tradition. And custom and tradition. And custom and tradition. So say government policy and custom and tradition, how do they basically affect the demand? Demand. Respond with a yes if you're together. If you're together, we'll respond. That's assignment. So then we go to individual demand and market demand. Individual demand and what you call the market demand. So individual demand and what's called the market demand. Individual demand and what's called the market demand. Individual demand and what's called the market demand. Individual demand and what you basically call the market demand. Individual demand and what's called the market demand. So I want to start defining what's called the individual. Individual demand. What is this that called individual demand? Individual demand. Jane, what do you think is individual demand? When you say individual demand, so individual demand is amount of commodity that individuals are willing, amount of a commodity, of what they call of a commodity, that say that an individual is willing, and you say and able to buy, and able to buy, we say at a given price over what we call a given period of time. So when you talk about individual demand, is the amount of commodity. And look at the word that an individual is willing and able to buy at a given price over what we call a given period of time, over a given period of time. Is that understood? Then we talk about the market demand. We talk about what's called the market demand. So we talk about market demand. Now, market demand, there are many people are together. When you talk about market demand, is what we call aggregate of individual consumers' demand. Aggregate, we call it aggregate of what we call of individual consumer demand. So we call it the aggregate of individual consumer demand. That is what we call the market demand. So a market demand is essentially what we call the aggregate of individual consumer demand. The aggregate of individual consumer demand. So if you're looking for aggregate, we can call it DM. This is the market demand, is equivalent to say D1 individual 1 plus D2 individual 2 plus D3 up to. There can be up to how many? That's what's called the market demand. Respond with a yes if you're together. So diagrammatically, I can also represent it in just say, if I have this is D1, this is price, this is quantity down here, this is quantity, then I can say plus, the second individual we can have, that's D2, we understand that price, here is quantity, then we say plus, we have D3, this is price, this is quantity, then up to GN. Up to GN. So with that, when you add this up to that level, we'll have what we basically call the market demand. So GM. Respond with a yes if we add them. If the point is at home, respond with a yes. So then I want to talk about why people demand for goods and services. Why people demand for goods and services. Why people demand for goods and services. Say why people call it demand for what they call for goods and services. Why would people demand for goods and services? Why would people demand for what's called goods and services? Why people demand for goods and services? Why do people demand for goods and services? That's a question. To quench, to satisfy what you call a basic need. Perfect, together. Basic ones, you want clothes to put on, you want food in order to exist. There's what we call a number of reasons. One is impulse buying. Do you know impulse buying? Some people just buy, impulse buying. We call it impulse buying. So number one is what's called impulse through impulse buying. There's no reason but you want to buy. You want to buy. There's no reason but you want to buy. There is not a reason, but you basically want to buy, but you want to buy. The second reason would be basically incentives provided by the government. You look at the time for COVID when the government was subsidized unga, and there was unga for 100. You'd find because it was being rationed, you'd find a family of 10 people going, all of them are going to put in stock 100, 2,000, and then the 10 family members take two. Are we together? So people buy because of incentive. When government provides, so people buy when government provides what's called incentives provided by government. People buy because of that. But again, you also have what's called the bandwagon. The bandwagon effect. You're buying because others are buying. I've talked about the bandwagon effect. You're buying because others are buying. We call it the bandwagon effect. But you can also buy because of what we call the snob effect. There's something called the snob effect. We call it the snob, so what we call conspicuous effect. You're buying luxury or expensive commodity to impress others. Have you ever bought anything to impress another person? You're buying expensive commodity to impress others. Have you ever bought? You're buying an expensive, we call it the snob, or what's called the conspicuous effect. You're buying an expensive commodity to impress others. Is there any person who has ever bought anything very expensive to impress others? Brian, have you done that? Jane, have you done that? And JB, have you done that? Have you ever bought anything very expensive to impress others? We call it the snob effect. Then we have what we call the Veblen effect. You bought an iPhone to let them, to impress them. Yes. Oh, nice. Yes. Then you have what's called the Veblen effect. What we call the Veblen effect. If you look at the Veblen effect, you're buying to show the public that you belong to a different class. You're buying to show the public that you're not in their level. Your level is quite high. We call it the Veblen effect. Then you have the basic ones. The basic ones are for survival. That is food, shelter, and clothing. The basic ones are for survival. That is for food, shelter, and clothing. Then we can also buy for speculative purpose. Umenunua shamba Kamulu, unasema iko karibu na barabara, so that in the future you can reap heavy on it. That is what we call speculative. Then we also buy in expectation of shortage. If today you are told, for example, that commodity XYZ is likely to be in shortage in the near future, our demand is going to rise in expectation of shortage in the future. How it can happen? Yes, to avoid shortage in the future. So we can put it down, avoid shortage in the future. Avoid, what is avoid shortage? Shortage in what's called in the future, to avoid what we call shortage in the future. The second, basic ones. Basic ones. These are for survival. When you say basic ones for survival, when you say basic ones, that is basically for survival, then you can say through impulse buying. You don't need it through impulse buying. We call it through what we call impulse buying. Through what we call the impulse buying. Through what we basically call the impulse buying. Through impulse buying, then you have incentive provided by government to encourage people to work, to buy. Incentives provided by government to do what? To encourage people to buy. To encourage what they call people to buy. To encourage what call the people to buy. Incentives that are provided by government to encourage people to buy. Government providing a cheap product, people buy. Then you have what's called the bandwagon effect. Because others are buying, the bandwagon effect. We call it the bandwagon effect. We call it because other people are buying, because other people are buying, because other people are buying. You're buying because other people are buying. Then you have what we call the snob effect. Effect to impress others, to impress others, to impress others, to impress other. Then you have what's called the Veblen. We call it the Veblen effect. So whenever we talk about the Veblen effect, show the public you belong to different class. Show the public you belong to what you call to a different class. Show the public that definitely you belong to a different class, Show the public that you belong to a different class. Show the public that you basically belong to a different class, Show the public that you basically belong to a different class. Show the public that you basically belong to a different class. That is what you call, we call it the Veblen effect. Are we together? Speculative purpose, are we together? For investment, speculative purpose, we call it speculative purpose for investment, for what we call investment. So speculative would be basically for investment. Together, that should be okay. So then we proceed to what's called interrelated, what we call interrelated demands. Call it interrelated demand. We call it the related demand. The interrelated demand. We call it the interrelated demand. We move to what we call interrelated demand. So on interrelated demand, I want to start with three. We have what we call a joint, so what we call complementary, composite, and competitive demand. So I start with the first one, joint demand. We start the first joint demand. So what we call complementary. So what we basically call complementary. So when you say a joint demand, when you say a joint demand, when we say a joint demand, when we say a joint demand, when we say a joint demand, when you say a joint demand, two or more goods that are demanded together. We say joint demand, two or more goods that are demanded together. We say joint, two or more goods that are demanded together. 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 That is what's called complementary. Two or more goods that are demanded together. Two or more goods that are demanded together. Two or more goods that we say are demanded together. Two or more goods that you are demanded together. Two or more goods that are demanded together. So that is what's called joints to what we call complementary. Are we together? For example, ink and pen. Ink and pen, e.g., we can talk about petrol and car, petrol and what we call car, and what we call ink, and what we call pen. Ink and pen, and what we call the ink and pen together. Then we have what we call competitive demand. We call it the competitive demand. Competitive demand. Call it the competitive demand. Competitive demand. So whenever we talk about competitive demand, we're saying refers to demand for substitute goods. Refer to demand for substitute goods. We call it refers to what we call to demand for what we call for substitute goods. So examples of substitute goods, demand for substitute goods, that is what's called competitive demand for substitute goods, e.g., tea and coffee. E.g., we say e.g., tea and what's called coffee. So e.g., tea and coffee. Demand for what we call substitute goods, e.g., tea and coffee. E.g., tea and coffee. E.g., tea and coffee. E.g., the tea and coffee. Yes, Blueband and Jam, yes, that is a good one, Weimar brand. Then you have what we call composite demand. We proceed to what we call composite. The composite demand. We proceed to what's called the composite demand. Composite demand. So when you talk about composite demand, we say that goods that are demanded, goods are used for different purposes. Number one, we say that goods are used for different purposes. Goods are, we say, used for what we call different purpose. We say that goods are basically used for different purposes altogether. For example, you look at steels, steel has different uses. E.g., we say steel has what we call different. Steel has different uses. So we basically say that the total demand for such goods is called composite demand. Total demand for such good, we say is called what you basically call composite demand. It's called the composite demand. The total demand for such goods is called a composite demand. It's called a composite demand. The total demand for such goods is basically called the composite demand. Then we have what's called derived demand. We call it derived. Call it derived demand. So when you talk about what you call a derived demand, when you talk about what you call a derived demand, so derived coming from somewhere. Whenever you talk about derived, it's definitely coming from somewhere. Are we together? So Debbie, Jane, and Wema, when you say derived, we are basically saying that the demand is basically deriving from somewhere. The demand is basically coming from what we call somewhere. The demand is definitely coming from what we call from somewhere. The demand is basically coming from what we call from somewhere altogether. So if we talk about demand, we say that describe demand for goods and services resulting from intermediate demand resulting, the word is resulting from what we call from intermediate, or what we call related, or the related good. So demand basically coming from intermediate or related good. So that is what's called derived. So just to expound it, cotton cloth, cotton as a result of cloth making. Are we together? E.g., some goods are demanded to produce other goods. E.g., some goods are demanded to do what? To produce. The word is to produce other goods. Some goods are demanded to basically produce other goods. Some goods are demanded to basically produce what they call other goods. Are demanded to do what? To produce other goods. Are demanded to produce other goods. For example, cotton for cloth making. So demand of cotton basically emanates from the demand of clothes. Cotton, let's say for cloth making. Cotton for what they call for cloth making. We call it cotton for what we call for cloth making. Cotton for what we call for cloth making. Then you have what we call independent demand. We call it independent demand. Call it the independent demand. So when you talk about independent demand, look at the word independent. I am independent. I don't depend on another person. Because when demand of a commodity is not influenced, occurs when what we call demand for a commodity, demand for what we call for a commodity, we say is not basically influenced. Demand for a commodity is not influenced. We basically understand is not influenced by the demand or consumption of another. It's not influenced by what we call demand, or what we call or consumption of another. Is not influenced by demand, is not influenced by what we call demand or what we call consumption of another. Occasionally, the demand for a commodity is not influenced by demand or consumption of another. That is what we call independent demand. I want to move to a concept, we call it movement. Movement along the demand curve, so changes in quantity demanded. Movement, we go to movement along the demand curve. So what we call changes in what we call in quantity demanded. So what we call changes in quantity demanded. So movement along the demand curve or along the demand, so what we call changes in what we call in quantity demanded. So movement along the demand curve, movement along what we call the demand curve, we call it the movement along the demand curve, movement along the demand curve. So what we call changes in quantity demanded. So what we call the changes in quantity demanded. So what we call the changes in quantity demanded. So what we call the changes in what we call quantity demanded. So what we call the changes in quantity demanded. So what we call changes in quantity demanded. So what we call changes in quantity demanded. So what we call the changes in quantity demanded. Allow me to draw the diagram. If I have the diagram here, so look up at that diagram. On the y-axis, we have what we call price. On the x-axis, we have what we call the quantity. So on the y-axis, we have price. On the x-axis, we have what we call the quantity. I hope you team, you're getting me. Is everybody getting me? This is demand curve. This is demand curve. Are you able to get me? Are you getting me? I hope you are. So I have price one. Look at price one, and then I have price two. So if you look at this, so I have the price. So that is P1, P2, we have Q1, and then we have Q2 there. And then we have what's called Q2 there. So we have X and Y. So this movement along between X and Y, that's what we call a movement along the demand curve. That is what we call the movement along the demand curve, So you can see there's a movement like this, and there's a movement like this. So movement between X and Y, that is what's called movement along the demand curve. So changes in quantity demand, so the changes in quantity demanded. Are we together, team? If we are, then you respond with a yes. Are we together? I want to see if you're alert. Thanks. So I want to come up with something. We just discussed something. When price is low, when price, we say is low, and say at P1, when price is low at P1, comma, the quantity demanded, we know that the quantity demanded is high, and say at Q2. So are you able to see that when the price is low at P1, the quantity demanded is high at Q2? Are we seeing that? Are we seeing that? Are we seeing that? Are we together? Are we seeing that? So then you say when the price is increased at P2, look up when price is increased. When the price is increased to what we call to P2, when the price is increased to P2, when the price is increased to P2, when the price is increased to P2, quantity demanded, quantity demanded, when the price is increased to P2, quantity demanded, quantity demanded, quantity demanded, decreases from Q2 to 1. Quantity demanded decreases. And say from Q2 and say to Q1. So quantity demanded basically decrease from Q2 to Q1. Quantity demanded basically increase from Q2 to Q1. Quantity demanded decreases from Q2 to Q1. Are you seeing that? Decreases from Q2 to Q1. Are you able to see that? Are you able to see that? Are you able to see that? Quantity demanded decreases from Q2 to Q1. Perfect. So when that is happening, this causes the movement along the demand curve. This causes what we call a movement along what we call the demand curve. And call it from X to Y. So that basically causes a movement along the demand curve. And we're saying from X to Y. That causes a movement along the demand curve from X to Y. And that causes a movement along the demand curve. And you're saying from X to 1, from X to Y. Together, from X to Y. Are we together? So then we come back and say, on the other hand, and when the price is high, and you say at P2. So on the other hand, when the price is basically high at P2, the quantity, we say that the quantity demanded is low, and say the quantity demanded is low at Q1. The quantity demanded is low at Q1. On the other hand, when the price is high at P2, the quantity demanded is low at Q1. So when the price is reduced, we're saying that when the price is reduced, and say from P2 to P1, when price is reduced from P2 to P1, we understand that quantity demanded, we understand that increases, and we understand from Q1 to Q2. So when that happens, you reduce it, quantity demanded now increases from Q1 to Q2. We can see that. Are you able to see that? Are you able to see that? What Malim is saying, are you able to see that? This causes movement along the demand curve. We say this causes what we call movement along what we call the demand curve. And call it from Y to X. Causes a movement along the demand curve from Y to X. Causes movement along the demand curve from Y to X. Causes what we call movement along the demand curve from Y to X. That is on the movement along the demand curve. I want to start on shift in demand curve. We call it shift. There's something I've not mentioned, NB. NB, pole. That thing is very important. NB, brought about by changes in price, other factors are held constant. Brought about by changes in price, brought about this. When you ask what causes brought about by changes in price, changes in price. When you hear the word ceteris paribus, inamaanisha nini? Brought by changes in price, ceteris paribus. Other factors held constant. Other factors held, we call it held constant. Other factors held constant. Brought by changes in price, other factors held constant. That is what you mean by ceteris paribus. That is what you basically mean by ceteris paribus. That is what you basically mean by ceteris paribus. That is what you basically mean by ceteris paribus. That is what you basically mean by what you call ceteris paribus. Then we move to what we call shift in demand curve. Shift, call it shift in what we call in demand curve. Shift in demand curve. So what we call changes in demand. Shift in demand curve. So what we call changes, we call it the changes in demand. Shift in demand curve to what we call changes in demand. Shift in demand curve to what we call the changes in demand curve. Shift in demand curve to what we call the changes in demand curve. Shift in demand curve to what we call the changes in demand curve. So if you look at shift in demand curve, we can draw the diagram. Just a minute. So these are demand curves. So we have original demand curve, we call it DO. So then we have D1, D2, sorry. We have it D2, then this is D1. Then we have price remains constant. On that, you can see price, there's shifting to the right, there's shifting to the right, there's shifting to the left, and then we have that, we have what we call QO, then you have Q2, then you have Q1, then you have Q1. That is shift. There's a shift to the right, there's a shift to the left. Are we together? Are you able to see that? Those shift? There's shifting to the right from DODO to D2. There's shifting to the left from DODO to D1. Are we able to see that? Nipatie, yes. Come on. So when you have DODO, this is what we call original demand curve. We call it the original demand curve. DODO, we call it the original demand curve. DODO, D1. So these are new demand curve. When we talk about D1, and D2, those are new demand curve. Demand curve. So shift, you need to understand that shift caused by other factors. Understand that caused by other factors call it other factors, and say other than price. So those factors that affect demand, for example, season, for example, population, for example, advertising, it's caused by other factors other than price. At the back of our mind, we note that it is caused by other factors other than the price. Nipatie yes hapo kama tuko pamoja. So as you think about shift in demand curve, so changes in demand, it is caused by other factors. It is caused by what we call other factors other than price. It is definitely caused by other factors other than price. What are these factors? The level of advertising. We have issues to do with the level of advertising. We have population. We have the income of the consumer. So for example, we pick one factor. On this, we can pick one factor. We can call it income. Other factors other than price. So this is quantity. So if you pick one factor, for example, income, are you seeing? Give money, yes. Are you seeing? Are we together? Are we together? I hope you're together. You can have a small break, then you come back. A break of 10 minutes, then you come back. You can have a break, then you come back. A break of 10 minutes, then you come back. That should be okay. Can we give it to yes? Give it to yes if you're there. So give it a yes if you're there. If we are there, then we respond to yes. Sorry for taking a bit of time. I was trying to sort a few things, but it is now done. So we get back out together. I picked one of the factors. Look at him. I picked one of the factors, income, sorry. We say caused by other factors other than price, so income. So we want to say that as income increases, we say as income, as income increases, as income increases, as income increases, we say as income increases, quantity demanded increases, quantity demanded, we say increases from what we call from QO, Q2. So as income increases, quantity demanded will increase. You can buy more. So the quantity demanded will increase from QO to Q2. Are we together? This causes a shift in demand curve rightwards. This causes a shift of what we call of demand curve rightwards. So this basically causes a shift of demand curve rightwards. It causes a shift of demand curve rightwards. Rightwards. Are we together? From rightward from DODO to D, call it to D2, D2. So this causes a shift in demand curve from DODO to D2, D2. From DODO to D2, D2. Together, team. From DODO to D2, D2. Give me a yes if we are there. From DODO to D2, D2. Together. Together. So we call it upward shift in demand curve. Rightward shift is so-called upward shift. See, upward shift in what's called in demand curve. So-called the upward shift in demand curve. We also call it the upward shift in demand curve. We also call it the upward shift in demand curve. Are we together? So we can call causes of rightward shift in demand curve causes of what we call rightward shift in demand curve. So what will cause the rightward shift in demand curve? Causes of what we call the rightward shift in demand curve. So one is increase in income. Increase in income. We have increase in level of advertising. Advertising. Increase in the level of advertising. Increase in the level of advertising. We have issues to do with favorable taste and preference. Taste and what's called preference. Then you can talk about favorable season, favorable season. You can talk about increase in what's called population. So what you call increase in population, what you call the increase in population, increase in population, what you call increase in population, increase in population, what you call the increase in population, increase in population, we call it increase in population. We can talk about what you call favorable season, increase in population. We can talk about favorable taste, favorable government policy. We can have favorable government policy. Government policy. Together, favorable government policy. Respond with a yes when you have favorable government policy. 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 We call it the favorable government policy. So then we talk about the other side. That is on the other hand, a decrease in income. On the other hand, and we say a decrease in what's called in income. On the other hand, a decrease in income. On the other hand, a decrease in income. A decrease in income. On the other hand, a decrease in income. On the other hand, a decrease in income leads to decrease in quantity demanded, leads to what we call to a decrease. We call it decrease in what's called in quantity demanded. Leads to what we call a decrease in quantity demanded. So on the other hand, a decrease in income basically leads to a decrease in quantity demanded, leads to a decrease in quantity demanded. We call it from QO to Q1. Let's say from QO to Q1. Are you able to see that? Are you able to see that? From QO to Q1. So say that this causes a shift of demand curve to the left. This causes what we call a shift of what we call of demand curve to the left. A shift of demand curve to the left. And we call it downward shifting. We call it downward shift in demand curve. We call it downward shift. We call it the downward shift in what's called in demand curve. Downward shift in demand curve. Downward shift in demand curve. And you can see from DODO to D1, D1. So from what we call DODO to D1, D1. From DODO to D1. So NB, movement along the demand curve is brought about by changes. Movement in a shift in demand curve is brought by other factors. Causes, we go to causes of leftward shift. We call it shift in demand curve. Causes of what we call leftward shift in demand curve. So the opposite of this, we have leftward shift is downward shift in demand curve. We call it decrease in income. One will be decrease income. We have decrease in level of advertising, decrease in what we call in level of what we call of advertising. Decrease in the level of advertising. Then talk about unfavorable taste and preference. Unfavorable taste and preference. Decrease in population. We have unfavorable season. Then unfavorable government policy. We can talk about unfavorable government policy. Government policy. Or you can talk about issues to do with there's no facility. There's credit facility, no credit facility available. Au Kenya. Respond with yes if we are at home. Kama tuko pamoja, tubonyeze yes. So NB. So I said shift in demand curve is caused by other factors other than price. So the word is shift in demand curve is brought by changes in other factors. Brought by changes. Brought, say by changes. By what's called by changes in what we call in other factors. And say other. Brought by changes in other factors other than price. So this one is not affected by price, by changes in price of the product, by other factors other than changes, other than other than changes in price. Other than changes in price. Together, team. Nipatie yes kama tuko pamoja. Then you go to exceptions to the law of demand. Exceptions to the law of demand. Exceptions to what we call to the law of demand. So what we call regressive, call it regressive demand. Exceptions to the law of demand. So what we call regressive demand. What we call exceptions to the law of demand. So what we call regressive demand. So exceptions to the law of demand. So what we call exceptions to the law of demand. So whenever we talk about exceptions to the law of demand, this goes against the law of demand. Exception goes against the law of demand. Understand that goes, let's say, against what's called the law of demand. Goes against what's called the law of demand. So when you say exceptions to the law of demand, it goes against the law of demand. The law of demand was saying when the price is low, the quantity demanded is high, and when the price is high, the quantity demanded is low. So when it's say exception, demand is low at low price. That is say, i.e., demand is low and say at low price, and you say and high at high price. That is what you mean by exception. Brian, unanipata? Jane, unanipata? If you're getting me, you respond with a yes. If you can get me, then you respond with a yes. Good if you can get me. Good if you can get me. Perfect. So then what are these exceptions? Applies in the following circumstances. These exceptions apply, we saw that apply in what's called in the following. We'll call it in the following circumstances. They apply in the following circumstances. So we can have those circumstances. So number one circumstance where it is applicable, we have given goods. We have what's called the given goods. So given goods, we say that demand increases with, Jane, what did you say about given goods? That demand increases with increase in price. Another exception is fashion. Fashion. You know, when something is in fashion, people don't care about price, so it goes against the law of demand. Law of demand. They say future expectation of increase in price. Future expectation of what they call of increase in price. Of increase in price. So when you expect that the future, the price are going to be 3 times, even if you increase it a little bit, people still buy. Are we together? Then you have what we call Veblen. Another exception, we call it the Veblen good. Veblen goods. So what we call the luxury goods. Veblen goods to what we call the luxury goods. Veblen goods to what we call the luxury goods. So we call it the Veblen goods to what we call the luxury goods. So Veblen good to what we basically call luxury goods. So Veblen good to what we call luxury goods. Veblen goods to what we call luxury goods. So if somebody was to sell for you gold 20 shillings, would you agree with that price? If I was to come and tell you gold is 20 shillings, are we together? Would you agree with me, Jane? And I have your gold and it's 100 shillings or 20 shillings. Would you agree with me? Number one, you wouldn't even agree with me. If I was to say that one, you wouldn't, it's fake gold. So these are goods whose demand basically increases with price altogether. So then we say necessity like medicine. We can talk about necessity call it necessity, such as medicine, So God forbid, if you have cancer, it doesn't matter. Cancer, then you'll buy it altogether. Then you have habit-forming goods like alcohol. People don't care. Habit-forming goods such as alcohol. We have what's called habit-forming goods such as alcohol, habit-forming goods such as alcohol and cigarettes. These people don't care. They'll buy cigarettes. Habit-forming goods such as alcohol and cigarettes. Habit-forming goods such as alcohol and cigarettes. Then you can talk about ceremonial goods like Christmas card. Ceremonial goods. Call it such as Christmas cards, such as the Christmas cards. Ceremonial goods such as Christmas card. Ceremonial goods such as Christmas card. Political stability in a country. When there's political instability, we call it political, and say instability, ability in a country. So when there's political instability in a country, that is not affected. Political instability in a country, but you also have ignorance. We go against the law of demand because we're ignorant. Have you ever seen some people buying shoes in town in the middle of the night? Some people buying shoes very expensive, and when you go back at home, you realize that those are two different pairs. Why do you go against the law of demand? Because you're ignorant. Because you're ignorant. Are we together? Because you are ignorant. Ceremonial goods such as Christmas card, people will buy. When it comes to Christmas, people basically buy that altogether. People will buy that altogether. Where consumption of a commodity is being forced by government, consumption of a commodity, consumption of what we call commodity, you say enforced by government. Consumption of a commodity is basically being enforced by the government. Would say consumption of a commodity being enforced. For example, installation of safety belts. If you look at installation, we talk about installation of what you call of the safety belts. We have them as installation of the safety belts. When you look at the installation of safety belts, they were very expensive because the government was basically doing that together. Are we together? So then this is where I want to stop. Reasons why demand curve. Reason why demand curve is negatively sloped. Do a research on this. This is where we start. Reasons why demand curve is negatively, we call it negatively sloped. So this is where we are going to start. Reasons why demand curve is negatively sloped. So in our next class, we start on reasons why demand curve is negatively sloped. So I want to say thank you, Jane, and thank you, Wema Brian. Unless you have something, we'll stop at that point so that you can now get rest. God bless you and God bless our class. Is there any question? Is there any question? Is there any question? Sawa. We'll meet in our next class. God bless you and God bless our class.